How do you make a presentation on insurance sound interesting? Throw in an ethics credit, right? Or serve alcohol. We can't do the latter, so we're going to do the former. So as we get started, and we'll talk about what we're going to do today, I want to introduce ourselves. I'm a partner in Haynes and Boone. I've been involved with ACC, as Susan said, forever. We're the original sponsors of the family baseball day at the ballpark, which actually started, interesting enough, at one of these presentations. I gave one on insurance at the Seattle ACC chapter, and afterwards I had some drinks with some of the members, and I said, how did that go over? Well, it's pretty dry stuff. What would make it better? Well, maybe you could do it at like a baseball game or something. And I thought, baseball game? Oh, that's an idea. We'll forget the presentation and just do a baseball game. In any event, I want to introduce my colleague, Brian Singletary. Brian works with me on a lot of matters. Brian's in our Fort Worth office. He's a graduate of OU and Texas A&M Law School, was first in his class in law school, and clerked for both Judge Pittman and Judge Means over in Fort Worth. And he's fairly new to the insurance area, which I'll tell you a little bit about. Those of you who know me, I've been doing this for 35 years. I started off doing commercial litigation and employment law, and found my way into representing companies 30 years ago, because I wanted to get some business from a client in the commercial and employment area, and they already had somebody else, and they said, well, you can look at this case and tell us what you think of it. It was a trademark case. I didn't know anything about trademark, but I found a way to get insurance to pay for the lawyers and settle the case, and I got hooked on it ever since, and so I've been doing it for 30 years. So in any event, our goals today are do a little overview of D&O insurance, talk about some relevant rules of professional responsibility, do some issue sponsoring for y'all, especially in two areas. One is on renewal of your D&O policies. I don't know how involved or if you're involved. Typically, that's handled by risk managers and CFO. But I have found in recent years that law departments are becoming a lot more involved in the renewal process. And as you're going to hear today, ethically, you cannot simply rely on your broker for a good renewal, and neither should you rely solely on your outside counsel that doesn't have insurance experience. But we'll get into that. The other thing that we want to talk about is some issues that arise when you actually get a claim, and what is a claim. A good part of our work that we do is on the litigation side. Probably 60% is representing companies and all sorts of insurance claims, property damage claims, environmental claims, but also D&O claims. And the D&O insurance area is very tricky. And many times we are called in to try to salvage a claim on behalf of a company, and it can be very difficult because the other lawyers involved in the case didn't recognize their obligations on the insurance policy. And D&O policies are claims made and reported policies. If you don't follow exactly the letter of the law and get them reported timely, you can lose coverage. And then we're going to touch a little bit on just a couple of issues, recent developments in D&O litigation that I think you might relate to, and just some pitfalls and mistakes to avoid. So that's where we are. And then I thought we would start, as I go back and get ahead of myself, maybe, Brian, we talk a bit about the history of D&O coverage, because as I said, there's different policies you've probably been involved with. You've probably done property casualty policies or general liability policies, employment practice policies, but D&O is a real special animal. So
yeah, thanks, Dave. And my job here is I'm new to D&O coverage cases, and Dave has been doing it so long. My job is just to try to keep Dave on track because he's got so much knowledge. I'm just going to keep us going. But yeah, D&O to me was actually always kind of intimidating. And like a lot of specialty areas, there's a lot of jargon that's kind of a barrier to entry. But even once you get past that, one of the issues with D&O cases is not only do you have this very specialized insurance area, it's insuring very complicated underlying issues, securities cases and other stuff. So it's like complicated stuff on top of complicated stuff. But that gets kind of the competence we'll get to in just 1 minute. But before that, like Dave said, I want to give you a little history. And I thought this was interesting when I was studying for this, is that D&O coverage and D&O insurance didn't even exist at all until about the 1930s. And even in the 30s, it originated with Lloyd's of London. It was a pretty niche specialty product. And that's because a lot of jurisdictions in the United States, they were afraid that the insurance was unenforceable. It would be void for public policy, because what you're essentially insuring is people messing up, directors messing up their jobs. And so there was a lot of concern that maybe this whole insurance isn't even good. It won't work. Delaware led the way, as they are wont to do in these kind of areas, in saying with a statute, no, you can do this. We will enforce these types of insurance policies. But that wasn't until the 1970s. I believe the policy, that statute came in, and it was maybe the late 60s or early 70s, and it's continued to be tweaked some, but it was at that point where these policies kind of became more mainstream. But in the big picture, that's not a lot of history, and these policies are still fairly new. And you'll see a lot of the issues that come up is because the language is very specific, and you always have to be focused on the language. But to start with kind of an ethical overview, and a reason for everyone in this room should really care about this subject, and that is the competence. Now, the ABA Model Rule or Texas Rule 101, this is the basic stuff. You have to be competent in order to provide representation to your client. In your case, your client is the corporation you work for. I think a lot of law or in-house lawyers might believe, yes, I have this insurance matter come up, or I have this employment matter, this securities issue, whatever it is, let me go get the expert for that matter. And you understand that. You need to get the expert for a securities matter or whatever. But I don't know if you always necessarily think, I have an insurance issue come up. I need to get specialty counsel for insurance to look this over. And maybe go to the next slide. There's a few instances here, and Dave can pitch in some more specifics in a second, but here are some real reasons you might want to consider thinking about insurance as its own specialty, especially D&O insurance. So this first case, Jordak Enterprises, it's 1998, but I think it was Guess Jeans. Anyways, there was a trademark dispute over some apparel. Like I said, I think it was jeans. And the company that it was Jordak had hired to defend themselves in this trademark litigation, they initially said, we don't think this is covered under your insurance, your D&O, or it was a general liability policy, I think. Right. We don't think this is covered. Now, remind you, their engagement letter scope did not say anything about insurance. It was simply defend us on this trademark litigation. So they say, we don't think that's covered, but we're going to keep going. They press on. Eventually, I think it was Jones Day, but a new firm comes in to represent this Jordak company, and they say, look, y'all need to go look at this. I believe there might be coverage for insurance. You might be able to get this all paid for. Turns out it could get it settled. California Supreme Court, it sort of dodged the issue because there was a limitations question involved, but it very strongly kind of suggests that the first law firm, which is this Brodeck, Felger, and Harrison law firm, they might have had a duty to inform their client if their insurance counsel or insurance coverage is available. And it's not a huge step to go from that to, if you're an in-house counsel, you might have an ethical duty to ensure that if you've paid a lot of premiums over the years, that you're using those premiums when the time comes due. The Darby v. Darby is a similar case. I forget the exact facts of that. The New York courts, this is not the highest court in New York, this would be like the intermediate court, but the court there said, no, there is no duty generally for a firm to investigate insurance coverage if that's not what you're specifically retained to do. But what's interesting about that opinion is you look at the commentary surrounding it, it's criticized by everybody. Everybody says, no, we think that if you are hired to handle a matter, part of your duties and representation is to see if insurance coverage might be available for that matter.
And you know, one of the pitfalls that I see working for big companies is you might have a big self-insured retention, $5 million, $10 million, maybe it's $100 million in some cases. And you say, well, I don't need to worry about insurance. We got a $50 million retention before any of the insurance is attached. Wrong. Because you have duties under your policies to give notice to your insurers, And depending on the language of your policy, you may need their approval. For example, many D&O policies, most nowadays, have approved counsels. So you got to pick off this panel. Now you can negotiate and put your own counsel in there, but you got to talk to the insurance company first. So we've had cases where somebody said, well, the first 15 million is ours, never going to get to our layer. Guess what? It does. And then they say to the insurer, we want you to step in here, and the insurer says, you never gave us notice, or you didn't keep us informed of this. And we're not giving, or the other thing is, we don't give you credit for the fees that you paid up to that $15 million attachment point, either because the hourly rate was different or whatever. So it does affect you, even though you're self-insured at even a high level.
And also on this, some other rules, ethical rules to be in mind, are the rules about what seemingly don't apply to this, but it's like the rules for a law firm. You know, the supervising attorney has a duty to ensure the lower attorneys or non-attorney staff are appropriately managing the rule or managing the case and following the rules. We've seen a lot of cases where I think in-house counsel or even outside retained counsel think, well, the insurance brokers, they're handling all that notice stuff with the insurance. They're handling all that. You really can't just throw off your duty to the insurance broker. They may be a lawyer, but that's not their job, is to ensure you're getting your coverage. So I'd be careful about just delegating that down to an insurance broker as well.
Right. And insurance brokers are good, and we work with all of the major brokers, but they don't litigate these things. And you know, when you litigate stuff, you really see where it goes wrong. So just again, sort of a quick overview, so there's some context. You know, there's 3 sides to a typical D&O policy. Side B is what reimburses the company for the fees you pay on behalf of officers and directors that are sued, if there's coverage. Side C covers the company itself, and then Side A covers the individual liabilities of the directors. And Side A is what officers and directors really care the most about, because if you're in a situation where there's insolvency or for some reason the company's not going to indemnify them for the legal fees and costs, then Side A kicks in. And as we go through this presentation, you'll see that language really matters in this thing, and so hence that's why we're going to talk about renewal, because the language of Side A, when it kicks in, whether there's what we call priority of payments, one of the cases that Brian and I currently have is a situation where a company faced a number of outside lawsuits and government investigations, and so they triggered both Side B and Side A. Then the company went into Chapter 11, and Side A kicked in, and the insurance company, citing the priority of payment, said, well, we're going to cover the officers and directors first, and they had really active litigation. We're not going to reimburse the company for its own fees and costs. And so we eventually got it reimbursed. But again, it all comes down to the language of the policy. So the other thing is, you know, what's a claim? And we're going to go into more detail on this, but this is the typical definition of a claim: a written demand for monetary relief, which everyone gets that, a request for a tolling agreement, or et cetera. And you know, timely reporting is always required. It's unlike a general liability policy where it's occurrence-based. The claim has to be made during the policy period, otherwise there's no coverage. So the other thing is you know, what does a notice provision look like? And this is a typical notice provision. Insurance policies, if you've seen them, they tend to be hundreds of pages. And the one thing that you can never rely on is what you originally get may be amended by endorsements. And you could have hundreds of pages of endorsements, and endorsements will modify other endorsements, will modify the notice and claim, you know, reporting provisions. So all of that is really important to understand on renewal what the endorsements might be, because you may not get all the endorsements in advance. I had a client one time that got an endorsement, much to their chagrin, after the policy was bound, that submitted any dispute with the insurance company to binding arbitration in the United Kingdom. Was not very happy about that. His board was even more unhappy about that. So we were able to get that tossed out because it was a kind of an after-the-fact endorsement, but you know, it cost the company some money.
Well, one thing to note here too is all D&O policies are claims made and reported policies, modern current policies. And what that means is it doesn't really matter when the actual underlying events occurred. It's when did the claim get made and when was it reported. And that's what your policy period covers, is the claims made and reported. And those words are not necessarily very intuitive either. So a claim, and I think we get to this more, what a claim is? Okay,
Yep.
We'll get to that in a second then.
So the other important part of insurance policy is all the definitions matter, and if you just think how this is constructed, you'll have a bunch of definitions. They'll say, what's a claim, what constitutes loss, and they'll say, this is all the stuff we cover, and then they introduce all the exclusions that, restricts coverage. But we're raising this because this is a case we have right now. So this is a definition of loss in a current insurance D&O policy that says loss means, and you can read it, but what's important is it says that any insured is legally obligated to pay, including that portion of any settlement which represents the claimant's attorney's fees. So if you think about a class action, and that's the kind of case we have a securities class action, a big portion of any settlement tends to be what you have to pay the plaintiff's attorney's fees, right? So our client has this in their policy. Our client had a class action. Our client settled the case. So then we moved on to,
I think.
yeah, we need the next one.
Yep.
There we go.
No,
So there
this
we
one,
go.
yeah.
So, and the company that issued this policy to our client touted this broad coverage back in 2014 when they issued this language. They issued press releases that say, we offer the broadest coverage in the D&O market because we offer a broad definition of loss, which now includes plaintiff's attorney's fees associated with the settlement. And those of you that have been involved in any kind of class action, that's always a big exposure. It could be employment, antitrust, D&O. The plaintiff's lawyers take a big chunk of it. And so they're out marketing this policy through their brokers, to all the brokers in the country, saying, look, choose us over the other insurers. And in fact, for a period of time, the first few years after 2014, they were the only insurer offering this. And a couple of insurers started modifying their policies to add this language. Not all of them did, though. So we go to the insurance company and say, we want you to pay this $28 million settlement that that our client had to pay, which was court approved, and the insurance company's reaction was quite different. They said, we're not going to pay it because the company's not legally obligated to pay, which is an interesting defense because a settlement of any kind is a legal obligation. Likewise, a settlement that's approved by a court, I say, is legally obligated to pay. So stay tuned, we're litigating this. But this reminds me of, it's Halloween, the Great Pumpkin, Charlie Brown, and Charlie Brown says she's going to pull the football away. I have a signed document. Well, but it wasn't notarized. If you remember, pulls the football away and never notarized. So anyway, that's why language matters. Okay, so we talked about what is a claim. All right, and so we're going to walk through some of these things because obviously everyone knows the service of a complaint or similar pleading as a claim. But here's a couple of interesting things. I'm going to talk about the tolling agreement, Brian. I'll let you talk about the monetary or non-monetary relief. But most people wouldn't think that a request for a tolling agreement is a claim under a D&O policy, most D&O policies. And where we have seen this is we have had cases where the client comes to us, they've tendered to the insurance company's investigating, and one of the things insurance companies always do, first play in the playbook, did you give timely notice of the claim? And they look to see when the claim arose. And sometimes you'll have, especially if you have interesting cases, whether you had notice of a claim or a claim was it in this policy period or that policy period. And so we've had cases, we had a client lose coverage on an antitrust matter because it turned out that when they got a notice of the complaint, the client contacted their outside counsel, who was not an antitrust lawyer, but did all their employment stuff, and they said, we'll find you an antitrust lawyer. They called up the other side and said, could we just have a tolling agreement while my client gets counsel? Sure, of course. And everybody forgot that. We were 3 years into the litigation, hundreds of $1,000s into litigation with the insurance company when this email pops up, the request for a tolling agreement, it voided coverage. So, Brian, why don't you talk about monetary and non-monetary relief? That's a new development. It's a recent case law in Delaware.
Yeah, so let's imagine a situation where you get a letter from or get contacted by the SEC and they say, hey, we want to start interviewing some people. We want documents. We want you to litigation hold, keep all your emails, and hold on to everything because we might start investigating all this stuff. So you contact your insurer, right? You say, hey, look, I just got this notice from the SEC. I'm pretty worried about it. Well, is that a claim? Is the SEC just saying, hey, we're going to come start looking at some documents, hold on to everything, and don't delete anything? Is that a claim? What about then if the SEC's not opened up any official matter yet, so as far as you know, then if it turns out 6 months, 9 months later, you learn that the SEC actually did open up an investigation, but it was a confidential order that you weren't even aware of and until months and months after that. And so when you tell the insurer about the claim, then is that a claim for monetary or non-monetary relief? And I think this is, you think of the word claim, and I think this is true throughout D&O insurance as in probably some other areas, but the words are not very intuitive. You think claim lawsuit or something similar to a lawsuit. You don't necessarily think a letter from the SEC saying hold on to your materials, a litigation hold type of letter. But it turns out there's some law that says, look, there's a difference between Joe Smith, the private individual, sending you a demand letter saying, I might sue you one day, litigation hold, don't delete any documents. And that's one situation. And then a little different is the federal government, the Securities and Exchange Commission, coming to you and saying, don't delete any documents, hold on to everything, we might start investigating. And
yeah, well, so for example, a lot of D&O policies cover, they say a proceeding is a claim, because they look at legal proceeding, but investigation is not, right? But if you look at the history of the drafting of investigation, they're thinking of an internal investigation. Like if you say, hey, we might have done something, so we're going to do an internal investigation. That's the real genesis of that. But the insurers take the position investigation is barred. So like with an SEC, you get a letter that sparks an investigation. Now, is that a claim or not a claim, right? We are arguing now in pending litigation that it is, and we're fighting with insurers over this. And our position is, which has been recently helped by a recent case in Delaware, is you don't have a choice, right? I mean, with the SEC or the Department of Justice, it could be a False Claims Act, it could be the FTC, it could be any government agency. When they write you a letter and they say, we want you to produce witnesses and documents, you have two choices. You can say, okay, or you can say no, and then they'll issue a subpoena. And all of their internal documentation on investigation say, if the target cooperates, that will be taken into account at the time of settlement negotiations. So, frankly, you're insane if you don't cooperate with the government. So, we're litigating that right now, and there's a recent case in Delaware where the Delaware court said, you're right. If the government is asking you to produce documents or witnesses, that's a demand for monetary or non-monetary relief that's coercive. And it's not the same as if it's a private party that writes you a letter with litigation hold. So we'll see.
And you see here some of the other materials that have been deemed to claim like a subpoena. That's obvious that there's coercive action taken in the subpoena. But from the insurer's perspective, they kind of got you one way or the other, whenever the SEC sends that letter. Because what are you going to do? Not comply with this SEC's request, which is obviously going to be bad for your company in many different ways. But you say, oh, but maybe that's not a claim, and I need to get this covered. Do I have to wait till it's a subpoena served on me? So, that's one thing. The language of these policies, they do tend to kind of follow each other and come in batches, but the particular wording is always very important. And again, that's another reason why you want someone to really look at this. And I believe we have a question in the back.
Right, finance is like, and the D&O market, the whole insurance market is really hard right now, and all kinds of insurance. The insurance companies are taking the positions that they're taking a beating on all the property casualty with the hurricanes, et cetera. Maybe they are. But I've had clients whose D&O stuff has doubled in price, and same thing with property casualty. So, you know, the finance side says, God, we don't want to report this because we're not even sure we can get coverage, even if it is a claim, and it'll affect our underwriting on renewal, okay? Well, I'll tell you what, it's false, because and during the underwriting process, if you don't tell them about it, and they find out about it later, they'll move to rescind your policy. That's what they do. I'm just telling you right now. So if you end up with a claim, a real claim later, and they come back and they say, well, wait a minute, and again, I'll use an antitrust case. So I had a client that was in a particular market, and some other manufacturers in that market were subject of an antitrust lawsuit. They were not. They were in a kind of different part of the market space. They were smaller, you know, smaller manufacturer. They renewed their insurance policy, and they increased their limits. When the class action hit the newspapers, Wall Street Journal and some other things, even though they were not named, the insurer moved to rescind the policy, because it turned out our client belonged to a trade association, and they went to this stuff where they talked about the fact that they had this class action pending against some of the people in the industry. And our client said, well, we're in a different market, you know, we're smaller, we have all kinds of reasons why they were in a different position, and they had no reason to believe they would be named in that. The insurer took the position that they had notice and knowledge of it, and they didn't disclose it in the underwriting period. Now, we ended up getting coverage for other reasons, but to your point is, you run the risk of not reporting, because even if it's not a claim, it's what we call notice of circumstance.
Yeah.
And then they say, well, that would have affected our underwriting, right? Which is baloney, because they're still going to give you insurance, you're just going to charge you more for it, right? So the answer is you should report it anyway. I know finance doesn't want to do it, risk doesn't want to do it, but the problem is you could really lose some big coverage. So
Well,
great question.
We have, on that question too, we have another case with a big client, and there was a big issue came up, and there was a lot of internal concern about would we report this, the consequences of reporting in all these other areas. But I think the answer is, you at least, to evaluate risk, you have to know the analysis and you know the potential consequences. And this client didn't really go through that on the insurance side. And so now they're stuck with tens of millions of unpaid legal fees that they should have got coverage. And then one of the main defenses from the insurer is, you didn't notify us. Right. And so you at least want to be aware. I mean, if you're going to balance risk, you at least need to know what the facts are. And so I think that's something like this client really didn't do a great job of at the time.
So I guess the one thing we want to say is on renewal, policy renewal, if to the extent you're involved in it, it's always good to have somebody look at it, like us. Frankly, we can do a side-by-side real quickly, because language does matter, and we'll talk a bit more of that later, but you know, certain policy provisions can really affect your coverage. Now, we want to move on to confidentiality in this rule. So as we said, D&O policies are reimbursement policies. You pay the defense fees and costs, and then the insurer is supposed to reimburse you. So this issue comes up all the time. So you've got millions of dollars in defense fees, and you ask your insurer to pay for them, and they say, well, give us the invoices. Well, you're going to give them the invoices, you're going to waive attorney-client stuff? No, you're going to redact the invoices, right? Well, if you redact the invoices, guess what? They may not want to pay it. And so Brian, why don't you cover that, and then I'll talk about costs with this.
Well, one step kind of before that is there's been recent developments especially, I mean, Texas is where I'm at mostly, but this is kind of national trend, that in order to ever get a court to approve an attorney's legal fees and get reimbursed for those from any type of fee shifting, you have to put detail in your billing statements. I mean, the courts won't approve that. Clients have a tough time paying for it if they don't understand what you're doing. So there's a lot of now incentive for attorneys to put information into those billing statements. That's good, except that now you really have a much higher chance of putting things in there that's like, I talked with client about this issue. Should we do A or B or C? And so there are attorney-client communications. There is work product information in those billing statements. And so you have to be aware when it comes to an insurer, a lot of insurers will hire these outside agencies to basically comb through these records and try to find some way to not pay for it, right? They have billing guidelines. That is another excuse, justification they can give to say, well, you didn't comply with rule A, B, C, or D of our guidelines. But the attorney's in a tough spot, and I've done multiple attorney's fees cases where, well, one, I need to put the information in there so we can potentially recover, but now all of a sudden you're saying, because I didn't, follow these rules over here, which if I had followed, I might not have been serving my client as well as I could have and should have. So it's kind of put in a tough spot. So one of the, some of these rules that, we might have a slide on the rules, I'm not sure. But some of the rules, like the billing guidelines the insurers require, have some interesting things that you wouldn't suspect. For instance, before ever doing any more than 3 hours of legal research on an issue, you have to get pre-approval from the insurer. Before filing any motion, regardless of how substantive, I mean, it's one thing for a motion for summary judgment, it's another thing for some sort of little motion to compel or something like that. But they say before filing any motion, you have to get approval. I mean, there's going to be dozens of these little rules. How do you enter your time? How are you segregating different tasks? And all those things could potentially be something to kick back and say, no, we're not going to cover that. And so it's put us in a tough spot, and especially when it comes to client confidences, you need to really be aware of that and have someone who knows what they're doing to look at that.
I'll just tell you, I'm waiting for the right case to litigate this, but the insurer billing requirements are unenforceable and they're a violation of the ethical rules. First of all, they're not ever part of the policy. They send them to you after you bind the policy, so they're not part of that contract. They make the argument that it's assuming the contract. But as Brian says, they have all these rules in there, and I believe that it interferes with the ability of your defense counsel to defend you, right? And they will go not reimburse you. They'll go back over your money you paid as your retention, your $5 million retention or 10 or 1 million, and they'll say, well, they spent more than 3 hours in this motion, dang, so guess you're 3 hours short. And they'll find a way to make you short of meeting your retention. Yes, Gary?
I don't know if you guys have experienced it yet, but they're doubling down on this and using AI programs to search through those bills.
Yeah, they are using AI. And so, they will back off because what they're really afraid of, and we've resolved 2 cases recently by saying to them, okay, fine, you don't want to reimburse our client for 100%? We'll file a deck action in federal court and find that your rules are unenforceable in violation of the ethical rules, and they back off.
And right now, there's not any law explicitly saying that, but there's a lot of opinions that are suggesting that, and that's clear where the courts are going. Is a lawyer has to be able to represent his client and do a good job for his client, and you can't be interfered with by some arbitrary rules from some third party.
Yes, sir. So the question is, so you pick one of their lawyers off their panel to prove counsel. How much can you push on them when the insurer says, well, we're not going to reimburse you 100%. We're going to cut your bills 10% every month, 20%, which they do, they normally do. It's a good question because they owe you, they're your client. See, the difference with a D&O policy than, say, a general liability policy, general liability policies are duty to defend, right? And so there's a joint, the lawyer that's appointed by the insurance company has a bilateral attorney-client relationship with the insurance company and with you, or the policyholder. So they owe duties to both. But not in the D&O sense. The D&O sense, they're their lawyer, they are your lawyer. The other thing is, a general liability policy with a duty to defend, the insurance company helps or controls the defense, right? Not with D&O. You control the defense. So my position is to your outside counsel, if they don't pay it, we don't pay it. You owe it to us. That's what I would tell them, to be quite honest with you. Now, the other thing I'll tell you is, at the time of renewal, if you have a firm that you would prefer that's not on their panel, you can ask to have that firm written in. The firm will have to agree to their billing rates, but the billing rates are pretty high in D&O, so they may take a little bit of a haircut, and again, that's something you can ask your broker to do or ask your coverage counsel. The other thing that comes up all the time and you got to be careful on are costs. They love to strike expert witness costs and they love to strike things like document storage costs and things like that. We had a client that had millions of dollars in extra cloud space that they had to store because they had this litigation hold thing and a subpoena from DOJ for 8 years of emails from researchers and professors at a research institution. And the insurer said, we're not paying for that. And we ended up resolving it with them because we had to sue them, but it was very significant. And they had all these excuses. Well, we use document. It's not documents. We're storing it in the cloud. Like they had this idea that they were buying equipment and they're putting these things on a computer. So a lot of times costs get missed, and you know how expensive experts are, jury consultants. Like who's ever going to go to trial, a big case without a jury consultant? Well, if you don't get their approval in advance, they don't pay it. So there are sections in the policies that talk about consent and voluntary payments, which we're going to talk about in terms of settlement. It applies to attorney's fees and costs. So, yes, sir.
One more question on the renewal. Endorsements, I've noticed from year to year, the insurers start giving you the same endorsement, but scaling back the language and the coverage within that endorsement.
Correct.
So assume you hire a Haynes and Boone to go ahead and help you negotiate the coverage. Can you say, hey, I want the 2018 endorsement in my 2024 policy? Is that a real thing?
Yeah, and actually the broker does the negotiating, but we can point that out and say, hey, you want to go back and look at this other language of the endorsement? Because the way it works is, they have these underwriters, right? And they'll come up with like this definition of loss. Somebody will have a great idea, like let's broaden the definition of loss. It'll give us a place in the market. So in this instance, it's XL Insurance Company. They introduce it in 2014. They tell all the brokers about it. Now the brokers start putting pressure on the other D&O insurers to do that. So they start drafting, some copy the language and some don't, or some draft their own. Then when we come in and we get, hey, guess what? You got to cover this settlement for plaintiff's attorney's fees. I guarantee there'll be an endorsement that restricts that language the next year. And they all pass it around. They claim they don't, but they do. So that's why the endorsements, you're spot on. It's so important to look at those things very carefully. There's another one which we'll get to later, but I want to talk about now, which is most favorable venue provision. That's relatively new in recent years, and it says something like this, and it's later on the presentation, but in the event there's a claim and there's litigation, the venue most favorable to the insured is applicable, or sometimes the language says insured and the claim is applicable, or sometimes the insured, the claim, and the insurer is applicable. Why does that matter? Because some states, like Texas, it's a case-by-case basis whether you can insure against punitive damages. California, void against public policy. Maryland, guess what? You can insure against punitive damages and multiplier damages. We had a False Claims Act case brought against a client in California by an insurer based in London, of all things, and they settled the case, and we asked the insurer to pay the multiplier, and they said, we're not paying that, it's not covered. We invoked the most favorable venue provision. They said, well, what? California doesn't, well, guess what? It was an alleged false claim submitted to the National Institute of Health in Maryland, and the client had a little office in Maryland, and the DOJ, U.S. Attorney's Office was in Maryland. So we said Maryland law applies. We got a court to agree with us, and they had to cover the multiplier. But no one had thought about that. And in the UK, they can insure against multiple damages too, and punitive damages. So they changed it next year. Lloyd's of London changed their endorsements to make that change. So anyway, the last point just about invoices, one thing I'll tell you is that there is an art to submitting invoices to the insurance company, and so they're like the DMV. If you don't submit it, check all the boxes and just reject it. So we always submit all the invoices with a spreadsheet, all numbered and everything else. Little things like that, you can get your staff people to do it that way. It will really expedite payment. And the other thing you want to do is, because they're so afraid of bad faith, they log every phone call and every email and every correspondence. So what you do is you tickle that, and you have your assistant every about 15, 20 days say, how's our invoices getting paid? How's our invoices getting paid? How's our invoices getting paid? And that puts pressure on the claims person because they get audited every year above, and if they see a bunch of unresponded emails, doesn't mean they'll pay you instead of on 180 days, they'll pay you on 100 days, but 80 days is 80 days, so in any event. So, well, I think we went through this, so we'll go through that. Let's move on here too. We want to talk about a really big area of litigation now in D&O area is we'll move on from this. I think we've beat the heck out of this.
Yeah.
I'll just cover this real quickly. On renewal, you want to make sure that Side A is non-rescindable. You're as an officer of the company, if you're an officer, you're going to want that. Your officers are going to want that. Your directors are going to want it. And the other thing is you want to look at the severability clause on knowledge, because again, that really matters. If it can be imputed to everybody, it makes a big difference than if it can only be imputed to one person. So in the case I mentioned about the antitrust case, we only had one officer went to this trade association. The rest did not. So that was one of our arguments, is there was a severability clause in there. We said it could not be imputed to all the officers, so in any event. Okay, so this is, the other thing on renewal is allocation. And, you know, what insurers do is, in all kinds of cases, D&O cases for sure, you'll have a combination of covered claims and non-covered claims, right? So you'll have, if they allege fraud, it's not covered. If it's negligence, it is, that sort of thing. So the issue is what happens when you've got a couple $1 million in attorney's fees defending a case, and some is covered and some is not. Well, there's allocation language in every D&O policy, and in some of them, it can vary very widely among insurers. Some policies say the insurer and the policyholder, the company, will do its best efforts to try to sort it out, and if they can't, the insurer will decide how to allocate, and when the case is over, then they'll go to binding arbitration or mediation. In other words, they're not going to pay for a big portion of it, and you're not going to get paid until the end. Other provisions call for other methods, including the relative exposure rule or the greater settlement rule, and some state law can govern this, which is again why venue provisions are very important. Delaware, for example, has the greater settlement rule. Brian, why don't you talk about that?
Well, yeah, so the two basic rules for how to allocate between a covered claim and a non-covered claim are the relative exposure rule or the greater settlement rule. I mean, the relative exposure rule is pretty intuitive in the idea of it, which is, well, let's just kind of allocate by percentage. You know, you say 50% was for this claim and 50% was that claim. Well, that's how we'll do it. But whenever you actually think about how to allocate between these claims, it's very difficult. And plus, if you're the insured, if you're the policyholder, that is not a favorable rule to you, because more than likely it's going to end up cutting into what's your covered payment's going to be. And you can imagine like a securities claim, for instance, against the company and its directors, a securities claim that also had some sort of tag-along, I don't know, fraud claim or something that wasn't covered. How are you supposed to say of this? I mean, it's all the same documents. It's all interviewing the depositions. They're all covering the same questions. When you get to questioning that lawyer that represented you, well, what percentage of your time on that deposition was for this claim versus that claim? Those are very difficult questions to answer. And what you're really going to be left with if you get to trial or litigation on it is a lot of risk and a lot of uncertainty of how that would come out. Several states, Delaware included, have adopted a different rule. And this rule, the greater settlement rule, tries to kind of smooth over those rough edges on the relative exposure. And they say, look, everything's covered except for the things that obviously included different work and new work. We won't cover those things if you can show that alone, you know, this expense, maybe there was one witness that was only relevant to this other witness, for instance. Okay, we don't cover that, but everything else, you don't need to start divvying it up and splitting it. It's just all covered under the greater settlement rule. So that rule is a much better rule for policyholders. You know, the one thing I'll also say on this is we've been litigating some of these issues. There's still not a whole lot of law explaining how some of these things work. And so you're still left with a little bit of uncertainty and risk. That said, you would much, much rather be in the greater settlement state, rural state, because that is a so much more favorable position.
And just as a practical example of this, in the case I mentioned, where we're litigating right now, is an SEC letter a claim, right? We claim it is, and it needs to be covered. So we don't have a decision yet from the court. We'll find out. But our backup position is, you know, all right, so maybe the company doesn't have side C coverage, but the officers and directors do. They're insured persons, and you know what? At the same time as an SEC claim was, the SEC investigation, there were a bunch of shareholder class actions. And the same firm is defending all of them. And what do? I mean, how do you decide whether you're dealing with the SEC or you're defending yourself in a class action? They're all related. That, everybody knows that's how it works. The SEC comes, up come the class actions. The real, and we'll leave some time for questions, but the biggest area that's going on right now in D&O, and companies face this, not just in D&O, but any kind of insurance context, is you get a claim, you get a lawsuit, right? You tender it to the insurance company, and the insurance company says, we're not going to cover it, or we're going to pay for your defense, but we have no indemnity obligations, and you disagree. You get into litigation, and your defense counsel says, you got big exposure here, we got to settle the case, because if you go to trial, we're going to get hammered, right? It's a securities case, it's a death case, it's, you know, you can put out. You go to mediation, you say to the insurance company, we got to settle this case, here's our defense counsel's report, we want you to contribute to settlement. They say no. We need you to contribute. They say no. You settle the case, and then you say to them, you should have settled the case, we want to get some money for the settlement. They say you didn't get our consent, it's a voluntary payment, we're not paying. Those cases are all over the country right now. It depends on the jurisdiction you're in. It depends a lot on whether they're defending or they're not. But the companies get in some really difficult positions. And we tried a case last year in New Mexico on that. We won. It had some unique facts to it. We've got some cases now where, and in the case in New Mexico, it was a wrongful death case, right? And in that case, the insurer completely said there's no coverage. We're not covering this at all. Once we established breach of contract, then it was Katie barred the door for all of it, all the attorney's fees plus the settlement. We have other cases where you have typically like a government investigation where you say, you know, we think you're wrong, we think you should be covering this SEC thing or this False Claims Act, and we're not going to cover it, we're not going to cover it, we're not going to cover it. And the other lawyers are saying, we better settle this because it's either $15 million today or $150 million if we go all the way, and you settle it. What you can do is if you put pressure on the insurance company, you can get them to waive the consent provision. I've been able to do that. It's hard, but they'll do it, especially if you say, if you don't, we'll just sue you. You get them to waive the consent and voluntary payments provision, and then you don't have to litigate that. Seems like a small thing, but it turns out to be a big thing. So anyway, that's in a lot of litigation. We want to leave some time for questions, if there are any. All right, good. Carriers delay giving a coverage position. So let me start with this. Some states have statutory provisions on that. Well, most states do, but some are not, are just advisory, not enforceable. So for example, Delaware and California have really specific, you know, they got to give a coverage thing within so many days. It's great, except you can't sue on that. You know, Texas has the Prompt Payment Act, for example. But so what happens is, this is how insurance works, right? They keep their money off the table as long as possible. So they don't give you a coverage determination to put you in a difficult position, because until you get a coverage position, what are you going to do? How are you going to settle a case? How are you going to hire counsel, right? Are you just going to sit there and let it go on, right? And they keep asking for information. You give it to them, well, they want more information. So the answer is, you have to put pressure on them. And you have to be writing them and saying, you're putting me in a difficult position. You're putting your interests ahead of mine. You start talking about bad faith. The thing is what you want to do is you want to tell them what's going on in the case, even though they don't want to know about it. Because then later on, if you get into litigation with them, they can't say they didn't know anything about it. And we've had cases where we have been behind the scenes, they never knew we were there, and we were telling defense counsel to write monthly status reports and say, this is what's going on in the case, and we literally, in discovery, when it got time to depose the insurance company, had their emails where they're saying, why do these guys continue to email me these status reports? We have no intention of covering this claim, even though they've never given a complete coverage thing. And guess what? Those cases settle. So it's a long way of saying, there's no, the only thing you can do, you can sue them, and I'll be honest, that's how you get their attention most of the time, is by suing them. Or if you get somebody that they know that does what we do and is not afraid to sue them, a lot of times you can prompt them to do things. Because, and let me just mention that for a minute. No one likes litigation. Coverage litigation is expensive. We try to avoid it at all costs. But the key to coverage litigation is you have to find some leverage, and don't treat it like commercial litigation where it's a World War I scorched earth. That's what they want. The way to win these cases is to find some element in their policy, like we did with plaintiffs' attorneys' fees, that's going to affect thousands of policyholders, and say, okay, fine, you want to litigate this? We'll go. And we'll go in a court with a reported decision, and when we win, your 1,000 other people who have this policy will be calling us and calling their lawyers and saying, hey, guess what? We have that too. And we have a FTC investigation, and we have a false claims investigation that we want you to pay for. That drives the settlement with them, not taking thousands of depositions and all that. It's, you want to have a really targeted approach. So anyway, other questions? Go ahead.
Yeah, and this is probably like a very simple question, but just like grappling with a little bit of the timing. So, as you have like a government agency approach, and just like a legal hold order, I think there's some hesitancy to like, that whole, notice of circumstance.
Right.
Is there like an appropriate timing? Is there like an argument for holding back and not reaching out to like trigger your policy, or would your recommendation be get them involved?
I get them involved as soon as possible, because you never know, right? Is it a notice of circumstance or is it a claim? The story I always tell was we represented a city one time that had an affordable housing program, and over the course of 2 years, they had people come to the city council meeting every month and get up and complain about the affordable housing program. And there were two different insurers, and the question is, at what point was it a claim? Was it a claim when they just got up and said the thing is terrible? Or was it for sure at the end when the lawyer got up and said, I represent these people and we're going to sue you if you don't, pay us some money? Well, it was somewhere in the middle of that. And thankfully, they had given every notice of everything. Well, here, and the insurance company's like, why are you sending me this guy's remarks at the city council meeting? But we said, do it. Send it to them, send it to them, send it to them. So, because that's the other thing insurers do. If you are two different insurers, they'll try to do this. The insurer that you tender to, oh, wait a minute, it really occurred in the prior policy year. And the other issue is, with notice of circumstance, there's a relate back issue with notice of circumstance. So, for example, again, let's look at this SEC thing. So let's just say that in this case we have that initial SEC letter is not a claim. It's definitely a notice of circumstance. And under the state's law we're in, it can relate back to that notice of circumstance. So if a claim later matures, in other words, what happens later is then you get a subpoena, right? Or in this case, the SEC issued a formal order but didn't serve it on our client for 2 years, or our client didn't know about it. Is the order the claim? Or the client didn't want to wait for the subpoena, but the subpoena definitely would have been. That notice of circumstance under this state law, it relates back to that. So the insurer has an obligation, they're on notice of the claim, even though the actual claim might have been 2 years later, that notice of circumstance counts. So that's a long way of saying you give notice of everything. I know it's contrary to what you're going to hear from finance and risk, but and maybe even your broker, but I say give notice of everything. So, well, great. Thank you. Appreciate it.
Yeah, thank
Anybody
you.
email us. We're happy to send you stuff.